our today's lecture. Again, good evening or afternoon, everybody who had find the time to enjoy with us. And usually, we will start with lecture, which our purpose is to discuss with theoretical frameworks about this international business. And the purpose of our course is, like I said in the first time, is that by step we try to understand what is the theoretical frameworks and some theories and methods about these international businesses through the seminar readings and home readings. I hope you will more closely can understand what is the practice of these topics or these themes. And I decided that perhaps in the fifth or sixth time I will try to put all these theoretical aspects in one paper. So if you cannot manage or cannot understand all these aspects which we have discussed in this time, and then we will do it in near future, don't worry, I try to put all this together, so perhaps we can in one day more closely to look at, and then I will explain you how all these theories and all these methods are tied with each other. Because when I see or talking with my Estonian students, they will sometimes say me that there is lots of or too much this kind of aspects and theories and methods, and perhaps they could not understood how these different methods and different approaches are tried with each other. So my purpose is that in one day I hope that you can get like this one-page overview, all these approaches, all these theories, but since I haven't done yet, we still going through these theories and methods. And today's sorry, not that right slide. Today we go on with these some theoretical frameworks like usually, and after that we go to these your home readings and see what you have written here and how you can understand what was the purpose of these articles. So again, I will go back to these theories of these multinational businesses and multinational enterprises and foreign theories. And some of them I already mentioned, some of them we already know something about this, but I will add some other theories which try to explain what is the purpose of this internationalization and multinational businesses itself. So we already know what is the absolute and relative advantage theory, which tried to explain it. Perhaps this is one of the oldest theory. When was said that why the countries and governments and companies are interested trading with each other, and the absolute and relative advantage theory says us that we can divide the countries perhaps in different parts and their location, their geographical advantages, or some historical advantages gives to the governments, companies, and countries some purpose, which production or which business models they mostly used, and which and what kind of companies are mostly represented in some different countries. The absolute advantage theory says to us that if some country or region have, for instance, climatable or geographical advantage like warm weather or some conditions to grow some specific foods and to find some minerals as well. So these companies located in these countries, they usually take this advantage and try to produce these kind of products and goods, which is more cost more less than which we can only get from these areas. Like I said, that bananas will unfortunately don't grow in Estonia, or we cannot pump the oil in here. But in otherwise, others said that perhaps some kind of fruits or some specific materials we can find only in northern part of Europe or northern countries in the world. So basically, absolute advantage is based on mostly the regional differences in the world, and the companies can use this advantage to produce these goods which is more suitable or cost less to offer these to the other companies in other countries, and other consumers they cannot produce in their own countries. The relative advantage theory says us that if the countries are equal in the climatable or regional conditions, so they will choose which kind of goods or products are more costly to produce, which is what kind of production is cost less money, and then they choose what is their business advantage. For example, in Estonia, we are a very small country. We cannot produce some machineries or gas or oil, but perhaps we are quite famous to produce something which we can eat, like milk products or vegetables like potatoes, something like this. Some of the countries, they have built their economy based on some knowledges, like countries perhaps where they can find some like I said, like some minerals, but they are very famous to I don't know, production of some kind of higher technology goods. Like Switzerland is famous for their watches. I don't know, Sweden is famous again some kind of high-tech materials, and this is also like relative advantage, and it is like basis of today's international economy, that every country, and then we can say that every company must understood that if they wanted to produce something in their home country and sell it to abroad, they need to take count this relative advantage. The second theory, which also explains why countries and the companies concentrate what they will producing, is Hexler-Ohlin neoclassical theory of foreign trade. And this theory says us that each country concentrates on the product of goods in which they have comparative advantage. It's like next step of this relative or absolute theory. The comparative advantage means simply that what kind of goods are the production is cost less. The country concentrates to production of these products of goods. So the main aspect is money. But we can say that in some aspects we will today see that the Hexler-Ohlin theory also explains us why some countries are not selling, but they offering only for workforce. We know that in some of Asian countries, people from Asian countries usually working in some other neighbors in abroad. It means that how to say, workforce or life resources or work resources. They have very much people in here, and the people cannot perhaps find a job in their home countries, so they can offer their skills and knowledges to abroad, to another countries. It's also somehow some kind of relative advantage, and every different aspects as well. If you wanted to see why one country concentrated in one production of one selection of goods and the other choosing absolutely different ways. Then product life cycle theory says us that the normal moving from home countries to abroad is focused or based on the product life cycle. Product life cycle means that in every product goes through 4 different like steps. I will draw you the simple model of the product life cycle. Just a second. I'm sure this kind of, I don't even remember. Perhaps I know this kind of, okay. So this is a very simple model, and it's called Boston Matrix. I don't know, have you heard about this? Boston Matrix model, or how to say in simple word. It says that every product, perhaps every product, I don't know, it's 100% true, but let's say that every product goes in their lifetime through 4 different like steps. They need to go through these matrix. It means that when you created something new, let's say that I will find a new solution, perhaps how to I don't know, create a new cell phone, for example. In first step, the cell phone is new. The product is absolutely nobody knows it. Nobody has seen it, nobody have touched it. And you can imagine the skepticism of the consumers when they will see something new, which perhaps not very usual or very common product or service. So then we can say that the first step, which the first moment of the life cycle, all the products, they call the question marks. This is like the first period of the product life cycle. Then, if the product is, the company invested lots of money, they're making marketing, they try to explain to consumers what this product will do, how this product will help you in get some kind of advantage, whatever things. Then, if the product will still alive, then perhaps goes the next started the next step, which we can call stars. Every product, usually when the how to say, the people will buy more and more, the sales is growing, then we can say that the popularity of these services or goods will start rising. We can say that the product will go the next step, and they will name it like stars. After that, when everybody knows what is and the popularity is growing and growing, then we will see that in some day will go the time or the period when the sales is not growing anymore because their best days are over. But anyway, the product is famous, everybody bought it, and then the company get a good sales list, and we can say that this is like a cash cow. And the final step of the product life cycle, we can say that this is dogs. This is strange names of this matrix model, but it explains us how every product will go through their life cycle, and the moving is going like this through these lines. What it does mean in our international businesses, in the meaning of this, it means that if the product is like going to end of this home market, then it doesn't mean that nobody wants to buy it anymore, or the company decided not to produce that anymore. It means that the company can sell these products next step to the abroad or the international market. And again, we can say that, or already otherwise, we can say that in every production which started in the home market, not any product, but lots of products which will start the production of home markets, in some day perhaps will go abroad because the mass production needs now less skilled labor, or they don't need anymore some kind of development skills. And we can see that very oftenly the yesterday's, let's say that this kind of luxury products or very expensive solutions, we can see that it's everyday's products for all of us. And the companies usually decided that if the production is cost less money than it was previously, perhaps it's more comfortable and more profitable to move to production, and all these like selling and then selling these products goes to other countries. So it means that the life cycle theory says that through these production life cycle, we can see that also the production, the finding resources, and the sales distribution goes from home country to another country, whatever they located. And it also involves that the countries, they will just looking for not only innovation, but they are looking for cheaper labor. And that's why we can say that we can see that why lots of production goes to, for example, in Asia or even in Africa, because it doesn't need anymore at first very skilled labor. And the other point is that perhaps they don't sell anymore so successfully in the home countries. The companies need to find new markets, and it's like normal way to find the new markets to go into international market. And always there are some kind of markets which doesn't know about these products yet. One good example is Finnish company Nokia, which was perhaps 15 years ago the world's largest cell phone production company. Nokia was one of the most highly successful brands all over the world, but unfortunately they lost their advantage. But it doesn't mean that Nokia not still existed. They find new markets in Asia or in Africa where they are quite successful, but they're selling less high-tech cell phones in there, and perhaps they're producing the cell phones in Asia as well, or in African countries. But it shows us how these like life cycle theories working in real life. The third or fourth strategy or theory is called trade-oriented strategy. It means that if we're taking what advantage we will get or what advantage get the poorer country through this internationalization or globalization process, then the trade-oriented strategy says us that when the companies is seeking some kind of cost advantage, or they seeking some kind of additional resources, what they don't have, it is also good for those countries which we can say that they are poorer than the home countries, because they expanding world trade, they developing also this new market or new countries' economy. And if, for example, in here in Estonia, some famous and very successful company looking for new, not only markets, but looking for partners or perhaps workforce, or perhaps they're looking for some kind of resources, then if we can see in here in Estonia that we still have something to learn from them, we're very open and expecting that perhaps they will come in here as well. So through this globalization process, we can learn as well something from these companies. It will educate our workers, it will educate our economy, and even more, the smaller companies in here in our home countries, they can find some cooperation with these big countries. So trade-oriented strategy, which in one way, on one side, we can see it's like occupying some resources. It's not like it looks like, because in good partnership will like expanding all the like living standards and also expanding these kind of export target countries as well. And then also one additional strategy which called anti-trade strategy. It's very common for United States, and why they call it like anti-trade strategy, it means that mostly the companies from United States, they looking something from abroad, but they only try to take this kind of advantage they are looking for, and they they like don't give something back for these companies or these countries. So it means that, for example, that if you are a company, let's say that from United States, and you're looking for new partners or you're looking for new markets, and you're using this anti-trade strategy, it means that you just only try to find something which you don't have it. And for example, you find in I don't know, countries X, that there are some kind of very good technical solution. You try to use it or bought it, but you give it back only money, but nothing more. So you like like using their knowledges to grow your own advantage. And in this kind of methods, or this kind of strategy says that the winner is only this United States company or this company which is seeking for a new solution, but the other partner, they just get nothing perhaps only the money. So we can see that these two last strategies are like staying in opposite side, and when governments or the leaders of the countries, they looking or they see that in some big companies are seeking for new markets. Today they quite like strictly wanted to see and be sure that this company not only looking for example, cheap labor or cheap resources, but they are very much interested that what they will get back from these companies. Not only money. Money is the simplest way. The poorer country and the smaller country are very much expected that they're looking for some skills and some knowledges and some partnership. But it's quite hard because you can imagine that if we take United States and Estonia, we are like elephant and the mosquito. The difference is huge, and we must be very interesting for these bigger companies that they will give us back more than just the money. And the problem is that today, like these multinational enterprises, they of course, okay, they're looking for new markets and they perhaps offering something new as well to all the world. But their business model sometimes is very simple. They're just looking for the companies which are not very small, but they are suitable for their own. So they buying them, offering lots of money, and after that they perhaps even close this kind of new brand. Let's take Skype. Skype mostly said that born in Estonia. The story goes 15 years back when some Swedish businessman started creating this kind of business model we today know as Skype. And I don't remember when it happened, but the Skype was bought, was selling to the Microsoft. And today, as we see, everybody, of course, using Skype, but like I understand that that Microsoft is not very much interested about developing Skype anymore. And perhaps it will happen that in some days they will close the Skype, or they change, for example, the Microsoft own Teams or whatever called this kind of video conference solution. Okay, our businessmen and Estonia and these Swedish businessmen, they got lots of money, and perhaps their own life is going very well, but we can lose some very good and very fancy solution, and this is like common ways how sometimes the companies will do. So the different theories which try to explain how this foreign trade looks like today, they consisted these theories which like staying in the positive side, and the other side is this kind of theories which is not very nicely to see. But we must understand that we as like theorists or scientists, we must understand that the purpose of our work is how to explain or how to describe the situations, the conditions, and the way how the multinational enterprises are growing and acting in today's world. Then I shortly introduce you this kind of foreign trade model, which called by Gordon. It's one guy called Max Gordon, and he has created this model, which is named by their own name. And what Max Gordon was trying to do is he tries to describe the important criteria, how the multinational companies choosing their location in if they growing and expanding and then looking for for new markets. And the main aspects what Max Gordon is written down was the next one. At first, the production function consists at least three main factors. So if some international company are seeking for new targets, whether they wanted to sell something or whether they wanted to use some or seeking some resources, it's all based in three main factors. It's physical, knowledge, and working capital. It means that physical resources or physical capital means land, some minerals, some I don't know, physical things, which all we can see in touch in real life. The knowledge and the working capital is basically the same things, because the knowledge comes from working capital, but the working capital is workforce, basically. And this is the first, criteria, which means that every production function needs three different resources. Then Max Gordon says that the critical aspect for the multinational company is that the physical and the human capital should be fully mobile. It means that you can move this workforce and the physical things from one place to another. The human capital mobile is quite okay. It means that if some multinational company would arrange a new production plant in some whatever countries they would choose, they will seeking for the human capital and the workforce or the working capital, not only the home countries, but perhaps in the neighbors as well, or the human capital or the working capital should be available to moving. The physical capital means that all these production plants and machines or other things they needed, you can move as well from one place to other. Then the third criteria was that production functions and the supply factors of production have not changed over time, which means that basically the multinational companies, when they have created their own production systems or production ways, or like, let's say, fingerprints, it means that it does not have change. It should be stay at the same, because the easiest way to mobilize or moving the production all over the roads, it means that they wanted to optimize and standardize all this production. It gives the multinational companies cost advantage, and this is one of the main aspects or one purpose why the multinational companies are seeking for new targets on new markets. Then second aspect is, or criteria is, production has constant economies of scale. Of course, the multinational companies, they don't like these customs, taxes, or this kind of obstacles. They wanted to avoid these. They expected that transportation does not require any cost. Transportation not for free, but it's not important cost. They expected that production function and technology are the same in every countries. And of course, the only immovable factor at firstly, like I said, is labor. So basically what Max Gordon wanted to say us that through this empirical analysis, he found that mostly the multinational companies, when they're looking or choosing a new target markets, especially for production purpose, based on all these kind of criteria. Of course, I would argue against this, Gordon, or I would like to add some my own aspects as well. And I would say that today one important criteria why the multinational companies are expanding and looking or seeking for new markets is that they like, I don't know, their expandings are written in their visions or in their basis. So for some companies, it's like a question of the brand image that they have to be represented, or they had to be located in every countries or in every region in the world today. So why I can say that, because sometimes I imagine that why some huge companies are interested to go or to expand, for example, such a small countries like Estonia. We have very small market, and in every segments we have very few people. But then I realized that for some companies, it's not a question of the money or the bigger sales, it's a question of image. Because if you don't have some kind of branch or representative offices in every European Union countries, it means that your customers or your partners cannot find the support or cannot find you even in small countries like Estonia. So I would say that one criteria as well is that in sometimes the multinational companies, they just need to stay and be in everywhere as well. Now, if we're looking for the real life, then we can say that the companies, which is we can call the international companies, or they are part of international businesses, we can see that if you take all these kind of companies, perhaps they have millions in all over the world. But when we look closer, then we can divide it, all these strategies, why and how the companies are expanding or how they go international. We can divide it, all these companies, for the four different parts. All of these parts or all these are represented some special strategy. And here is the four main strategies, how we can see why companies are going international, what they are like looking or what is the purpose of their going global. And all these are based basically the same reason what we have talked in the first meeting. So my question that time was that why companies are going global, and then we discussed that there is a lots of different reasons. They are seeking for new markets, they expected more sales, they're looking for some special resources what they don't have, and etc., etc. So basically we can say that there is four different strategies. The first strategy called global strategy, which is based on the main reason why companies are seeking for new markets. It's a cost reduction and looking for new markets to expand or get more money, just simply said. And if the companies are looking for the cost reduction or they are looking for some kind of cost advantage, they usually using this kind of model or ways we can call that this is standardization. So the company will going through the standardization, and the common business model is very simple. In real life, we can see that this is a company who's selling everything in the same package, in the same size, in the same price, perhaps in the same lookings. all these kind of stuff you can buy from the supermarkets and all these everyday groceries. We can see that they're all based, this kind of companies based on the standardization, because cost reduction, getting more money and less costs, it's like one of the main purpose how you can be competitive and how you can be successful in the long period. And the global strategy, in simple sense, we can say that this is that the companies are just like taking all the markets and they're going to all markets in the same products. Not specifically, they don't change anything, and they expect it that it doesn't matter what kind of social or cultural habits or differences countries have. The customers anyway will bought it, and again, all these everyday goods and everyday services like Coca-Cola or McDonald's, they simply using the same strategy. The second strategy is specific skill strategy, and this means that companies can transfer some kind of specific knowledge and skills to the foreign market, and they will adapt in somehow or how they need it to do. Specific skill strategy again has two aspects. At first, one aspect is that it means that companies are changing their production ways, they changing their the way how they go to the foreign market, something they need to change in marketing or distribution or whatever things, because they need to focus on the specific market aspects, like cultural, like social, like economical. And the other part of the strategy means that going to abroad, you're not looking just in the first strategy, not only the standardization or cost reduction. This is not the main purpose. You're looking for something new, you don't have it. So you need to change your specific ways to produce, and you know that if you need to go to some specific countries, perhaps you don't have this kind of resources, you don't have skills, you don't have, I don't know, labor force with some specific skills, and you need to change something to adapt in these country specifics you're going to. Third step is adaptation strategy. It is pure adaptation activities, product and services. So basically companies cannot allow themselves to offer the same production ways, the same strategy, the same products, the same, even the administrative culture. They need to adapt all these activities or products in the conditions of the host countries. And this is today mainly used strategy for the smaller companies or these kind of companies who cannot allow themselves to sell standardized products. Mostly services, because services are based on customers' habits, customer expectation, and these kind of expectations are very different in different countries. Even the speaking language is different. So it means that you cannot offer the same characteristic products or services in every country in the same way. And we will talk next time about these cultural differences, social cultural difference. But right now we can say that even these countries like Finland, Estonia, and Latvia, which is all the neighbors and quite small countries and located in same geographical area, the people, we looks like the same, but our expectations are very, very different. So if some companies from Norway or Sweden or Germany, and they're offering services, they would like to go in here, they need to understand that not every time is suitable, or even it's not possible to offer the same products in the same way, in the same prices, and in the same conditions. And the fourth strategy is like integrating all these mentioned aspects. So basically, let's repeat that the main three strategies means that they are going deeply to the from the standardization to the adaptations. Every this kind of strategy need more adapt and more specify to the host countries. The global strategy is the simplest. It's one of the common models. We can see lots of companies, they offering the same products in the same condition, in the same way, and their like business advantage or like secret advantage or key advantage is standardization. Specific skill strategy means that the companies will focus on the specific knowledge and skills to the foreign market, and the adaptation strategy means all the adaptations of activities, products, services based on the host countries. Now we can ask that how much companies are using the transnational strategy and how much are using the other strategies. Then, of course, if we look closer and deeply and detailize all these activities, then we can say, of course, lots of companies are using the fourth, this transnational strategy, which integrates all the aspects. So basically, in examples means that global company need to adapt something. Minimum adaptation is using local language. The maximum adaptation is producing absolutely new products, which is suitable only or based only of the expectation of those countries. Again, I will repeat it and more closely going to these different strategies when we're talking about these cultural aspects. But you can just think about it. If you look products like some fast food companies like McDonald's, for example. McDonald's is using, in one hand, this global strategy, but the other hand, they need to adapt. So in every countries, not every countries, but in every region, you can find a little different menu from McDonald's. But the basic business model is always the same. So this is like example of the transnational strategy, which is company using like mix of these different ways. Now we can make a first step to the next theme when I will discuss about cultural and social aspects of the internationalization. But here is the very small, very simple and very understandable model. What is the four main group of the different aspects which every company need to understand? It is political, economical, academical, and social, cultural aspects of internationalization. So basically, it means that every company which is had some idea to going abroad, they need to understand that every country is different. At first, let's start from the political conditions. It means that in every country have their own law, their own some kind of national interest. The countries have different expectations. So means basically that some of the countries are more open, they more expected other companies in here to selling something. And some of the countries are not very open-minded, and they protecting their home economy through these some kind of taxes or custom costs and something like this. And of course, you need to understand what is the political conditions in the target countries, and even the identity or strategical alliances. What country is more closely than others? Usually, the political aspects are one of the most hard to imagine, because it's not so simple that you just read some news and analyze the latest political news or talking with the politicians a little bit. You need to find this kind of partnership with the new country's government or businessmen. You need to make this kind of lobby to open the doors, especially when we're talking huge companies, when we're talking a huge interest, when we're talking about the huge amount of investment. The investment and the interest of the companies and the countries is is going like accumulated. It means that a small amount of money and small investment doesn't expect very much protection, but the big money and the huge investment means that this kind of interest is going to the very top, and even the president or the parliamental leaders are asking the questions and perhaps interested who is this kind of company who would invest in some specific countries. Economical factors are the simplest aspect, because everything is written in statistics, everything you can find. There is no any secrets. How big is the target country's economy? I don't know how much their average salary of the people, or what is the financial situation in this period in these countries. This is the simplest way, because you can find everything from statistics, and we hope that the statistics are showing the correct data. Academic aspect means mostly the skills and knowledges and the education level of the host countries, because you need to sell something, or you need to find the workforce, and you expected some kind of skills from the host countries perhaps, and it means that you are very interested about perhaps even this. Can the people talking with another languages, or what is their mostly represented education level? Are they educated more in perhaps social sciences or technical sciences or something like this? And perhaps the most interesting and most unknown factor goes from these social and cultural aspects. This is something what we can say that it's most harder to understood. It doesn't help you very much if you have lived, for example, 1 year or even 2 years in some host countries. You still, if you don't have the local people, friends, or it doesn't even, this is not enough. If you not born in specific country, you cannot understand deeply the national identity, the cultural identity, or the some kind of social and cultural aspects. We have lots of countries where the faith and beliefs and norms and values are absolutely different, comparing our home countries. To understand, to feel this kind of human touch, only way to understand it, to like hire the local people who can help you to understand how the businesses looks like. And for me, it's very interesting to every time to see when some international company started their own businesses in here in my home country. And the next question goes from then, when I see that they are not very much successful, and then I will ask from myself, what was happening? Why they failed? Why they cannot be so successful than they was in their home countries? And there are some aspects, of course, I can see that perhaps they have done something wrongly. For example, choosing the wrong location for their branch, or they perhaps invested less money they need to invest, or perhaps the expectation of the sales was a little bit different. So they expected to get some specific amount of money, but they get less. Okay, this is like measurable aspects. I can see them, and the company itself can measure and say that, okay, our expectation was this, but the real situation was that. But mostly I'm interested how they can understood this kind of social, cultural aspects of the host countries, how they can understood how our people are thinking, are behaving, or what can they like understand our norms and beliefs. And what I can say in summary is, I can say that mostly the problem started from this aspect, that they cannot understand, or they don't like they don't go deeply to our people's minds. Some of the companies, they could be very successful because they are so huge, they are so famous, but sometimes it is only like imagine, it's not real life. Let's take all these kind of fast food companies. Of course, the fast food companies are franchise. It means that the owner of the companies in here in Estonia are Estonians. But okay, let's say that some of these famous franchise started their business in Estonia. First, I don't know, weeks, months, and even perhaps half of the year, they are very successful. People are waiting when they get their, I don't know, burgers or French fries or whatever, these kind of chicken nuggets. But after that, the interest in going down, and you can see that there is absolutely no people in the branches. What will happening? And then I start thinking that perhaps there was only this kind of like child is very excited. Whoa, yeah, something new. I'm expected, I don't know, whole of my year that this McDonald's or KFC will come in here in Estonia. But the real life is that if you have tasted a couple of times this kind of fast food, you can realize, there's nothing special. And anyway, I don't eat very much this kind of burgers. I mostly like only my mashed potatoes and pork fillet, and that's my favorite meal, not these burgers or Coca-Cola or chicken wings. So then I start realizing that again something was done wrongly. Perhaps the companies more deeply need to understand that some of the businesses are not suitable, or they're not very popular. Let's say simply not popular, but they not for our people. And of course, when our companies, our businessmen going to abroad, they perhaps can find the same situation, that normal people eating or using or wearing the same things, but why they don't buy my stuff? And there's lots of different conditions, there are different reasons. All of them, I would say, that are based on social and cultural identity and aspects. But again, I will explain it in detail and more deeply we going in the next seminars when you read the specific articles as well. Finally, we can say that we can conclude what is the most influencing factors if we taking whatever internationalization or whatever globalization idea. We can say that all these factors are divided by two parts. One of the internal factors, the other external. The company need to understand both of them. Some of them, like I said, you can very easily to calculate, to analyze, or to find information through, I don't know, media, through the statistics, asking or just looking. You can calculate costs, you can calculate the company's size, you can calculate the risks, you can test the products, all these kind of factors, you can test it. Some of them are these kind of factors that need to come from these new companies which are interested to going abroad. For example, sometimes the speed of the moving and the speed of the expansion is very important. Sometimes company size is the one factor itself. If the company had more and longer international experience, it's again gives some kind of advantage, and etc. etc. And the other part of the factors which is influencing the choice and the entry modes and the entry strategies is based on these external factors. It means that this comes all from the companies itself, but this comes from the target market or the country they have chosen to come. And here is lots of this kind of information you need to analyze, understand, asking whatever you need to do. But not going deeply to describing all these factors, we can say that every internationalization process, every globalization process, every step to abroad for whatever company we take is the combination of internal and external factors. And that's why we can see that we have huge number of multinational companies, but in somehow every of them are using their own fingerprints. They're using their own methods because in one side they eternal objectives and the purposes are different, and they are seeing and their expectations are different. And then when they going in some specific country, they could see that perhaps their objectives not going very they are very linked for these internal factors. They need to change something because not any companies are the same. Every company is a little bit different. What is the same is basically external factors. But if we take whatever company we take, then it means that internal factors are always different. That's why companies need every time to mix something. They mix their strategies, they mix their ways how to go abroad, they mix their objectives. So basically the combination of every internationalization is based on these factors. And of course they are not all. If we looking deeper and going inside of these factors, perhaps we can find another numbers of different factors. And of course, it means that if we take social cultural distance, these sub factors, we can write down tens and tens different aspects and different problems which we must calculate, and sometimes perhaps we cancelled our internationalization process because some of these external factors are against us. So this was the today's topics and today's theories. And again, I repeat that in some future seminars or lectures, I will try to explain what is how the combination and how all these theories are linked with each other. Okay, this is for the lectures. To have questions or something like this, or some additional comments. If not, then let's have a short break, about 10 minutes, and then we will go back and start discussing with the home readings and the home articles. Okay? I put the recording in the pause, and we will see about after 10 minutes. We can continue our today's meeting, and before we going to the today's articles, I first like to go back to the previous slides, and I don't remember exactly. I explained these two slides, but if I done it, I repeat it because one of today's articles are based on these models and strategies, and it's important to make it clear what and how the articles which calls us, just a second, analyzing foreign market entry strategies, extending the international approach. What is the main purpose of this article? And the idea, what they wanted to discuss with you or remind you is that usually we can see that the companies, when they're going abroad, they're using the two simple strategies or two simple approaches. We can call them horizontal strategy and vertical strategy. The horizontal strategy means us that the company will produce and selling the same products abroad as at home. So, like perhaps I said, that best example is Coca-Cola. Coca-Cola is selling and producing the same products, whatever countries they have, almost the same. And their main purpose is to get more money, to increase their sales, and this is quite simple. The other strategy, we can call them vertical strategy. They're based on this approach that companies are seeking different ways, or they are interested about different aspects or different resources. It could be the get more money, increasing the sales, but it could be I don't know, sourcing for raw materials or production, some semi-finished products, or seeking for the higher skilled workforce or just workforce. So it means that in real life, the company's headquarters located in the home countries, and the development located in home countries. But in abroad, sometimes they're seeking raw materials, sometimes they're using the target country for assembling something. So basically, we can understand that the companies are divided their production cycle in different like steps. So we can say that the different steps or stages can include, for instance, in the establishment of production unit or production process manager, or acquisition of foreign company, or investments, or establish the sales network. Basically, we can say that in every country's production cycle can divide it 4 main parts. The first is research and development. The second is production. The third is marketing, and the fourth is distribution. This is like 4 main parts, which include whatever components we will take it. And this vertical strategy, this means, so it means that every cycle, part of every stage of the cycle can done it in different countries. I know that that lots of companies, car companies, or some technological companies, they seeking for higher skilled force workers in abroad. They producing something or producing some semi-finished products in countries, but the final assembling and the sales going back to the home countries. And these 2 strategies, which means that whether we using the horizontal or vertical strategies, goes further. It means that after that, when companies have decided what kind of part of the business cycles are making in home countries and what is the foreign countries, the next step is the companies will choose the methods how to be physically invisible and represented in the host countries. So it means that we started with this indirect export, then was direct export, then licensing, joint ventures, and direct investment. And why I'm talking with this is because this article, which probably I hope that you read it, consists all these kind of terms and all these methods, so we can understand that the combination of strategies, how the company is going to abroad, is some kind of mix with these methods and the strategies or the part of the production or selling cycle. Now we can go with these articles and let's see what you figured out reading these texts. Let's take this first article called International New Ventures. Sorry. Not this. The second one. Yeah, this one. Analyzing foreign market entry strategies, extended international approach. And as usually, my warm-up question is how you can summarize shortly what was the purpose of this article, what you figured out, or what you, I don't know, get to know. Talk to me. What was the main idea to write this kind of article?
I think this article was looking at the different costs that different strategies would face when going international.
Okay, yeah, this is basically very short summary that there was some combination of different strategies and the strategy is based on the cost of different like steps which the company need to do. But okay, let's go much more deeper. The first part of the article was like introduction. I agree. What is internalization itself? What is the SAGE models? It was like a short summary, mostly of the previous articles, which we already read. There was mentioned the Uppsala model. There was mentioned what is the internalization in theory, and a little bit perhaps new for you was what is the mergers, acquisitions, greenfield ventures, and etc. Next, my question is how you can understand what is the greenfield strategy or greenfield method or this well itself. How you can understand what is this?
It's when you open up like a completely new business and you build it from the ground up in a new area.
Mm-hmm. And the main idea is that you built up from zero. You built up the production, the sales, distribution, marketing, everything. This is greenfield strategy. What is the other way? Oh, okay, let's take that we have here mentioned different strategies or methods. Some of them we already mentioned. There was foreign direct investment, then was joint ventures. How you can understand what is the other ways to foreign direct investment than greenfield strategies? What other ways we can find? How it looks like in real life?
There was also a joint venture.
Joint venture is like step behind this. Why we need joint ventures? Can you explain?
I think the article talked about upholding a monopoly price.
Mm-hmm. But have you had experiences to know some kind of joint ventures, or do you know some specific company which based on this kind of model or this way? Do you know in real life some joint venture?
There are some airline companies.
Yeah. What is the main purpose to, for example, let's take that I am the businessman from Estonia and you are a businessman from your home country, and in somehow we meet each other and we decided to organize or create the joint venture company. Why we will do it?
You don't have to bear the initial setup cost. So if I am from my own country, you don't have to worry about factory or warehouse. You just need to send me the product and I do the rest of the work.
But what do you expect from me? Why you are interested from me?
Because your product has a market in my country.
Yeah, let's say that that in other words that if two companies meet each other, one is from one country, then other second is another country, and the interest is the second one, the second country. So basically, you're from your home country, you know much more these cultural, political, economical factors. You know the people. You have facilities, you already had customers, market, and everything. And I can offer you, for instance, some famous product. Perhaps I have much more sales competence. I have some, I don't know, some famous brand I owned already. This is one purpose why the companies are merging each other and creating this joint venture company. That's right. And previously, I remember that that the joint venture companies was much more popular than they are today. But this is the only one part why joint ventures are quite important, or why even people or businessmen are thinking about this. There is another aspect as well. Can you imagine what other aspects we need to take account when we're talking about joint ventures? One was this competition and production and marketing advantage, but what aspects you can add more? Do we have people in here from China, for example? No. I will see the names and I don't recognize any Chinese name. Perhaps we don't have Chinese students in here. Okay, but perhaps some of you came from some Arabian countries. Have you had experiences to create a business or some business contacts in United Arabian Arabs? Yeah, this kind of, from Dubai, for example. No? Never? The other aspects I would like to introduce you is that somebody's writing me, just a second, to pull results together. Yeah, that was the same we already talked. But the other aspect is that some countries are not allowed just simply international companies to their market. China was one example. Even a couple of years ago, there was quite hard to open the branch or the new company in Chinese territory, because China not allowed 100% foreign companies. The laws said that if some international company or foreign company would like to open the new firm, they need to cooperate with some local businessmen. So it means that they need to divide the shares and the ownership in some specific percent, for example, 50-50 or something like this. Dubai or the United Arab Emirates, they opened their economical market or business market. It was, I don't remember exactly, perhaps last year. But it means that now you can open your new firm in Dubai, but previously it was not allowed because they protected their own country or their own business against the international companies. So basically, what is my point is that the second main aspect why we need to focus on or open the joint venture or organize our firm through joint venture these ways is that some countries not allowed 100% foreign companies at their territory. This is like the second aspect. But let's go back to this foreign direct investment. We decided, or we just get to know that one way is to organize or to create a company through these strategies, to using this greenfield strategy. But what else we can? We can use in other ways as well, and it was mentioned in the article as well. It is mergers and acquisitions. What is the purpose of these mergers or acquisitions?
I think the purpose is to basically share resources. I can think of an example, one merger that happened in India.
Yeah.
It was between Maruti and Suzuki. So the Japanese company and the Indian company was merged, and they created very affordable sedans and hatchbacks. So they shared resources. The Japanese, let's say the parent Japanese parent company, provided them with the designs and the technology, and the manufacture plants were based in India because the labor was quite cheap, and they resourced some of the materials from there.
Mm-hmm.
So, if you compare it against Greenfield Ventures, where you have to build everything from ground up and scratch up, it is quite favorable in that aspect. And also, you can use their local licensing, whatever regulations or whatever the regulations they may be subjected to. So you can use their, let's say, carbon emission licenses to produce your cars, your technology, and everything. So that way, mergers are quite helpful and lucrative.
That's right. Very correct answer. Very good. Usually, this is how it looks like. So the mergers and the merging two companies, they both would like to give some advantage of what they have, and using their own specific skills or knowledges or resources to create a better company. Against they both try to grow and fight with each other. But how you can see the difference, or how can you understand the difference between mergers and joint venture companies?
I think mergers are regarded as one entity. They can have multiple level of ownership structure, but on the other hand, joint ventures, I think it's on paper, like on technical terms, it's two companies, not one single entity.
Mm-hmm. Yeah, basically, this is like one, and we can say that joint venture is most legal order or legal statement, because, like I said, if some country put it the clause that you need to find some kind of local enterprise with which you can organize the firm, then it's more like legal act than real business. The mergers are both interested mostly with each other. Then the joint venture is sometimes just sharing some kind of risks, and this is okay, it's voluntary, but not so much like interest-based businesses. The legal document, perhaps sometimes it's not very different each other, but inside the meanings of these are different. But shortly, let's discuss about acquisition as well. Why these kind of methods are so popular? What do you think? It is the one of the simplest way to go to abroad today. What is the purpose of these acquisitions?
One thing that I can particularly think of is to kill the competition. If you're a powerful company with available resources and big capital, you can take out the smaller competitions or emerging competitions by buying out all their shares and giving them a very lucrative offer that they cannot refuse, and then you basically just buy the company and you can still use their name and use their brand reputation and whatever sort of client portfolio they might have. And that way you just kill the competition.
Mm-hmm. One of this is correct. One possible solution is, that's correct, kill the competition, and the worst result is that they will close the company. Absolutely, even they forget their name as well. They don't interested about the technology, the people. They just cut the competition. But if we take another opposite way, not killing competition, but using this, I agree with me that one purpose of the acquisition is to get much more easily to ticket to the new market. If you will buy absolutely famous or working company, you get the people, you get market, you get everything, and sometimes even the smaller companies are very much interested about this acquisition, because they can see that without a new partner or without a new investor, they cannot survive or they cannot grow. This is the problem of small companies which don't have very much money, and they can see that if they don't find a suitable partner or interesting partner, they're afraid that in next day will come some huge competitor and they just lose all they have, because sometimes the bigger competitor not interested about buying or merge these kind of home companies, which is a leader of the market. They just interested to kill them, and if the home-based company have not the resources or money or even these knowledges or technology, they cannot fight with this kind of company. And the way how company can survive and people can get a job and previous owner can get money is to sell to the company for the bigger investors. But why I said that this acquisition is very popular, we can see in every day that even bigger and bigger companies, they merge each other or they melt with each other. So this is quite normal process. We have perhaps talked that humankind or human being is a life cycle or life period, or we living in some specific way. The companies, we can illustrate the companies perhaps in the same example, that the company will born, they will grow up, and then perhaps in some days they stays in this kind of moment that they will die, or if they want to survive, then perhaps in absolutely new body, which means that they melted in the other bigger companies. But it's normal process. Okay, so let's agree that we have different option how the company can go abroad. We know that there is simple ways that indirect or direct export. Then we know what is the franchise. Did we talk about what is the franchise means in previous time? I don't remember.
Yes, I think we did.
Okay, and did I ask what is the difference between licensing and franchising?
I'm not sure that was mentioned.
Okay, but can you answer me? What is the difference between licensing and franchising? How you can understand the difference? What is the franchising? We basically know, but what is licensing? And why it's like not important, but again, quite common way to create a business or going to international. What is licensing itself means?
Does licensing mean that you get permission to use a specific technology or something like that, while franchising is more about control still?
Yeah, franchise is that you will get the full business model. You can access to the some logistic system, resources. You can be part of the global marketing, etc. But licensing means that's right, that you can allow to use some technology, some brand marks or trademarks. If you look at the retail business, let's say that mostly apparel business, everything which included to clothes and shoes and things like this. So all these, not all, but most of these companies are not owned by the name they using. For example, Hugo Boss or Giorgio Armani stores in whatever country we take don't belong to Armani or to Hugo Boss. They owned by local businessmen, but they have got the license to use this kind of name, and they can get the license to sell these famous products in their home country. Or you, for example, can use even simplest example, use Microsoft Office products in your own businesses. This is also licensing. If you go in Estonia to want to buy a new iPhone model, then usually you visited the local store, which belongs to Estonian businessmen, but they have license to sell Apple products, and they can offer the service and technical help based on their knowledge, which the Apple company will offer them. So they like official distributor or authorized dealer, how we can call them. Basically, if you look whatever brand name stores in usual country, they basically never belongs to this company which name they're using. This is like licensing. So it means that we have different option or different strategies how the companies can go abroad, and it was based on this risk and reward line. Some of the strategies consisted less risk and less rewards, and the other is opposite way. Then there is a like main point of this article is the model. And the model consists in two parts. The entrant, which means the company which is like I said, based on home country, seeking to sell the first time in a foreign market. And the other part was host country rival, which is facing the firm faces like rival, which is located in the particular country where the entrant would to come. How you describe this entrant, the points of which is written down in here. Here is 1, 2, 3, 4, perhaps 13 different points. What is the main aspect? What the author wanted to describe in here? And what you can like get the main point, what you can like figured out something important here. There is something interesting which we already shortly described, but let's take again talk with this. There is mentioned lots of different words and different definitions, and one I need to focus on, or I please focused on, is that point 3, the focus on the model or market entry makes it appropriate to distinguish between production activity and distribution activity. So basically, the author would like to say us that every firm may enter the foreign market focused on two main different steps or part or stage. One is production and the other distribution. And they simply says that the entry strategy is like mix of the or variation of these two different aspects. And the author says here, the firm may enter the foreign market either by owning and controlling production and distribution, production only, distribution only, or neither B or D. So what is the shortly the summarize of this idea is that in every company basically started the analyze based on two different main steps. They can go abroad either to start production in the selected countries or distribution, or the both. So in otherwise, what says this is two main purpose of the companies. Usually we understand that the distribution means that sales are just looks like it is much more important than the production. But this article is based on both sides. Either production and distribution is both quite important. And the author going even further with this and says that we can add additional aspects. It means that not only production and distribution is the main activity of the company, but additionally we understood that every company's business cycle starts from this research and development, and also the very important part of the business consists on the marketing activity as well. So like I write in here means that every company had like 4 different or main activities, which includes the business cycle. It's research and development, production, marketing, and distribution. And shortly says that all the based in 2 different ways is production and distribution. So the article shortly says is creating a model between these production and distribution activities, and the other side is different strategies, which was direct and indirect export, then joint ventures, foreign direct investment. So the model is try to find the combination of these 2 parts of these aspects, and in real life it means that we have lots of different combinations, which was already 12 and 12 different strategies, and the variants are the possible ways how whatever we take the company can analyze which is suitable for them and which is the better of them. What was the main decision aspect when, where, and why companies are choosing one of these strategies? What was the main decision point, or what is the based on this model?
It's the strategy that has the lowest cost for entry will be chosen by the company. So this is the
That's correct.
main
Yeah.
thing.
This was correct. So basically the model based on the cost analysis. And if you can see, it's quite interesting that what is the list of the costs? The list of costs consists like adaptation cost of production plant, or cost of building trust, or rate of interest, or additional transaction cost of licensing technology. So it means that the question is not that we need to analyze only some kind of transportation costs or costs of whatever, I don't know, building up something. We can say that these common name of this cost is alternative costs. Alternative costs means that when we do in this way or do in that way, what is the difference of these costs? Perhaps the simplest example is that when we decided either try to find some company to buy or to create the new company through the greenfield investment. So which way is more suitable or cost less? If the previous company or a company which is quite good situation, is like leader of the market, is cost less than creating absolute new company, then we decide to this acquisition, not the greenfield strategy. And not today, but the next time, or perhaps, yeah, I will explain one more strategy, but I can ask you, or perhaps you can answer me. What is, where is the point when the companies, or I know this is not a good question. Okay, I put in here some example, then when I can explain what was my idea is that if we take, I draw your, let's say that this is like home country and the company is located in here. Now the company is decided to go abroad. So that means that company will okay, they have some purpose to find new markets, to find new customers, whatever. And it's simple to understand that every step the company is taking to going abroad increases their costs. Costs are going beyond. And why the company is allowed to do cost? It is because they expected more sales. And now you can imagine, where is this deadline, or when the company will says that that's enough, not anymore like expanding, where this point will come mathematically.
When the cost exceeds the sale.
Yeah, the microeconomical aspect says that when costs is equal to the sales, or even let's be more specific. It's how it's called. PPP. Just a second. I tried to imagine what this was. I don't remember the name in English. Just. Oh yeah, no. When marginal cost is equal to marginal sales, this is like the optimum point of the companies. When the marginal cost will be the bigger than marginal sale or marginal income, then the company's expanding will stop. So this is like decision point. And the company is always for looking how to cut their costs so that the marginal sale will be the same as the cost or even bigger. This is like microeconomical how to say law or something like this, yeah. And this was one of the key aspects when the author is like describing this solution or this model. They're using different financial aspects or mathematical aspects, and what they created this kind of like mathematical model. So basically we can say that if we will take whatever company, and the company is like staying in the first step to go to abroad, then this model can help companies to analyze either the going abroad or going international is suitable or not. And the second question, which of these strategies are more suitable in like economical aspects. So here is lots of different alternative costs which the company need to like take account, and using the same model we can like find which of these 12 model is economically best way to us. Let's see this model as well. There is a 12 entry strategies and their variants. And you can see that here is 12 types, which is basically combination of these strategies we already have discussed. It started from this normal foreign direct investment, and then it's like, how to say, sub-variants. Only direct investment in production, only direct investment in distribution, subcontracting, either exporting on franchise or licensing or integrated. There is a lot of different combinations, and every combination has their own variants as well. And the decision for the companies is not only using the normal foreign direct investment strategy, but either the variants. Are the company choosing own the production and distribution, or the companies decided to like own only this production and distribution is used through partners, or again the production is used by partners and the distribution is owned by. There is lots of different variations, and the variation is described here like in text, and the other option is using this figure 1, and how to describe it. It's basically, at first we have here home country, which means that this is the entrant and this is the home country rival. And as we know that we divided whatever business activity in 4 parts. It was research and development, production, distribution, marketing. And if you see, there is 4 different steps: home location, production, foreign location, and final demand. And who is fighting in here. So we can see that, for instance, this first strategy, normal foreign direct investment, means through these figures that at first the home country at their home location focusing on research and development, then the production will create it at the home country, the distribution as well in the home countries, and the final demand, it depends on home or foreign countries. The other option or the other model means that the research and development will held in home countries, so does the production, but the distribution is used in foreign countries and using the foreign owner. So it means that this is the ownership, but this is the way how they do it. So the first entry type says that the research and development, the production, and the distribution, final demand, all owned by the enterer. Second option was that research and production was owned by home countries, and distribution is owned or like divided by the host driver. And this is like the scheme how we can understood and organize this kind of entry for the foreign market. This model gives us this kind of like simplified way and describing the possible variants of the company's activities or decisions. But there is some weaknesses as well. What you can say, what is the main weaknesses of this model? What is missing from here?
Maybe one thing that's missing is time, that these costs could change, that they're not going to stay the same.
Mm-hmm. Yeah, time is missing. But the time was included in these previous models, these behavior models. But yeah, of course, time is missing. And we can say that the speciality of this model is that authors specifically don't concentrate on time. But okay, that's correct. What else is missing? Or what is the weakness?
I think social, cultural behavior of the people.
Yeah, that's right. The very important aspects like cultural and social aspects are not included in this model. Why? Why we cannot add this to this model? What do you think?
Well, I think it's an omission because it is very critical to also put it in the model, because give or take, whether they come with joint venture or merger and acquisition, they are still going to contend with the behavior of the people in the market.
Mm-hmm.
So I think it should be there. Perhaps it's just an omission, or maybe it is something of quality. It's qualitative, it's not quantitative.
Yeah, that the last sentence was very important. We cannot measure the people's behavior in quantitative ways. How we can measure the expectation of people's behavior through the money? It's very, very important. Okay, very good. What else could be missing in here? If you look at the variations or the costs, we can see here is adaptation cost, production rate of interest. What else we can see here? Technology, marketing exercise. There is lots of variation. But like we said that if as the cultural, socio-cultural aspect is missing, they're also missing this political and like we say, academical aspect as well. Here is included mainly economical aspects. We can measure the costs of transportation or cost of some changing something or building something, but and even we can add a rate of interest in here. But again, how you can measure the political situation or political the stability of or stability of the target country through the money. So again, we like scientists, we need to be a little bit critical and said that okay, this is a very good model and we can analyze lots of things through this, but it is not the final and only the best model to choose where to go and how to go. So that's why we can say that whatever model or whatever strategy we try to analyze, we need to understand that always are like some variations which we never can calculate. We never don't know what will happening. Best example is when we look at the window, we see that now we have some registered viruses which moving silently and invisibly around us, and we cannot even ever expected this kind of strategy or this kind of problem, and even to take account it and calculate it, it's basically impossible. So that is the not say weaknesses, but this is the understandable problem. This is like this variable of the economy that you can analyze whatever things you would like to analyze, but you never can let's say take account every variable, every risks, whatever consisted in the real world. What do you think? I have very like this basic or common question that all the articles, even these and previous and the next articles, they describing something based on the future experiences. Can we learn something from future, or what we can learn from future, from the past to be more smart in the future actions? Can we learn something past, and what we can learn from past based on these economical things? Let's focus on international business, not the other things. What do you think? Can we learn something from past?
I think we can talk of some emergency situation like we just running through pandemic globally.
Okay. What other thinking about? In one side, we almost would like to say that, yeah, of course, we need to learn something from the past to avoid, I don't know, some risks or take account some risks. But real life shows us that the future is so unexpected, and it's, like I said, absolutely not possible to take account all the possible variations. So that's why these kind of models are always like half of the part. We can cut the risks or lower the risks, and we can let's say that using some academical models to, I don't know, cut off these kind of variations and these kind of strategies, which we can see that they never will be worked. But even if the company will decide, okay, I see that what strategy number 1 or 2 or 3 is most suitable for me, or most cost effective, it doesn't mean that it will be so effective from them, because perhaps the model was created or designed absolutely in different situations, different times, and different companies. But anyway, yeah, this is absolutely new discussions and not very much important. In summary, what was the main aspects you could learn from this article is that we have again different strategies which introduce the ways how to companies can go abroad, and the strategy based on financial or like cost of the money and cost of something we would need to accept when we're going abroad. And the model is mix between different strategies, which was this like export and joint venture and etc. And the other hand is compared and tied with real activities what the company will do in every day. It was research, development, production, distribution, marketing. So the real life shows us that whatever companies we take, they're always using some mix of these two variations. At first, the strategies, and the second is the real steps they take in account. So it means that in real life, we can say that some companies, their international activities is based on only in production. The other companies, they fully represented or own some kind of international companies and fully represented in new markets. It's not that one way is much more better than the other ways. It's the company's decision. And like I said, and finally, we never know that when and why the companies are decided to choose whatever country they wanted to come, because sometimes it's based on their image and the brand values, and they need to be in there when they want to be. Okay, do you have questions or comments from me based on this article? I hope that through these home readings and summaries you're writing me, you also learn something new, and after that we will shortly describe this, what was the main purpose of these articles. Then perhaps you can like more realized or get the new information, perhaps something you don't understood or misunderstood. So this is like the purpose of our course. That again, I said that the main goal is to move step by step and then take this piece of piece and creating this kind of bigger picture of this international business in the final. So let's do in this way that the second article, these influence new ventures, we will discuss in next time. In next time we will start with this article, and after that we will move to the social cultural aspects of the internationalization. Please continue reading these articles so that this lecture seminar number 3, study of social cultural factors and influence of the social cultural differences, please read it, and next time we will start with this article number 2 in here, and then we can go further with these social cultural aspects and what this means, and hopefully we can give each other lots of different examples, because we all came from different countries, and I hope that you have very good and very funny examples how the companies have failed because they don't understood your national habits, values, norms, or whatever things. Is it okay for you?
Yes.
So let's finish today. It's quite late, and again, my today's day was very, very long, and we will see after 2 weeks, yeah?
Goodbye.
Thank you, and bye.
Yeah, thanks. Bye.
Perfect. See you 2 weeks time.